Hi, everyone. Thanks for joining my course of Venture Analyst. Today we have our second lecture. It's a very important lecture because we will be talking about how VCs make decisions about their investments, how they structure information for investment committee, write investment memorandums, how VCs make mistakes, and what biases do they have when they make decisions. A couple of words about myself. I already talked about my background in in the previous call, and you can read it here. But like I've been for almost 10 years in venture capital. I have an aerospace engineering background and a financial background. I have experience running and failing a startup, and I'm an industry expert in the Industry 4.0, and I'm really passionate about space. And for the last couple of years, we've been developing with our friends a media project, Space Ambition, so you can go and check it out. Yeah, so this is the disclaimer. I don't do this course on behalf of I2BF. I do it on behalf of my own, and all the ideas and insights we have in this course is in my personal opinion. So let's start with the investment memorandum and how VCs make decisions. So investment memorandum is a document, an internal document of a fund. We write them to present the investment opportunity for the investment committee. During this course, we will have the case. We will look into the investment memorandums of Bessemer Venture Partners. So we will see how other VCs structure this information. Long story short, first of all, when you prepare for an investment committee, you prepare a document either in PDF or I mean in PPTX, so doing a presentation, or in doc format, where you cover all the main relevant topics, explaining why this investment opportunity is interesting for us to put money in. And you also add a financial model and financial projections and your calculations of the potential returns, as well as you provide to investment committee the term sheet you will sign if you approve the deal. Then there could be other relevant documents like client references, or if you're doing a due diligence, commercial proposal from due diligence providers, some other information which helps the investment committee members to better understand the investment case. So here are more than 20 topics that you need to cover when you put together an investment memo, and we will make a deep dive in it right now. So first of all, people love stories, and even if you make a presentation at an investment committee, you're telling a story after all, and typically it takes between 20 and 40 minutes to make a pitch about the investment opportunity and discuss it internally. So it's a pretty long time, and people could be bored. So to tell a good story, you need to say your main points 3 times. First, you do an executive summary, like spend 1 or 2 minutes, focusing the investment committee members' attention on the main points why you love the deal. Then you spend like 20, 30 minutes, discussing every single topic we will be talking later today. And then you make the conclusion, again, repeating the main points why you love the deal, and giving the recommendation, spoiler alert, the recommendation should always be to make a decision, because like to prepare an investment memorandum, you need like to spend like 10 to 20 hours and do business due diligence. So it's a pretty pretty expensive procedure for the fund. So like if if you make an investment committee, you should be like 75-80% sure that the deal should be could be approved and you really like it. So so you make the conclusion as well, and give your recommendations, and then like you can discuss with investment members how you could adjust this recommendation. So so the first section or the first slide of your presentation should be about the executive summary of the main points why you love the deal, and it could, for example, look like that. You can read it later on. So you can, first of all, you're talking about what exactly the company is doing and how it's different from other solutions. Then you tell about the deal, like how much they raise, where they in terms of the traction, some deal terms, and then you also say like why, like where the company stands right now and where it will be expanding after the round, so that like we understand like where we're heading into. So then you start explain each of the points in details, and typically you start with a problem. You try to explain what is the target market and what is the target, what is the problem that customers experience, and try to show that it's a painkiller, not a vitamin. So the problem is really itchy, and the clients are already paying for it or have a very strong intention to do so. So you try to show that the problem is real here. Then you make a market size. It's an exercise. We will have a separate lecture on the market sizing, and you will have the link at the end of this lecture. So first of all, you need to calculate the total addressable market and show that it's more than $1 billion. Then talk about the segmentation of the market, because oftentimes startups start from a small niche, then expand to other niches. So you show that as well. Then you talk about the key trends and showing why now is the right moment for the startup. And like 2 years ago, it was too early for that. A couple of years later, it would be too late for that. And also show the drivers, the main market drivers, which will be driving the growth during the next couple of years. And what you want to show is that thanks to the market growth, the revenue of the company will grow, and the valuation of the company will grow. This is an example of this exercise which we did for one of the companies. It was doing a solution for it was a construction company in the United States. So what we did is, first of all, we looked into the global a global construction market. So the United States is the second biggest market. China is the first biggest market globally in terms of the spending on the construction projects. But for whatever reason, the startup we were exploring was going to developing a solution in the United States. Okay. The other thing we looked into is they will provide an IT solution. Some suggest, suppose, some machine learning solution. And we looked into the engineering software market and saw that the penetration of this software in North America was 38%. This on one hand, that's meant that an average construction worker and a professional is using more IT software, more software than elsewhere in the world. So it could mean two things. First of all, it could mean that It could mean that like you have a more a tough competition, or it could mean that your potential clients are more open to using some IT solutions for construction. So in the case of that startup, they have the second case. So they didn't have a very strong competition. Then we looked into various segments of the construction, and we looked into single family and multi-family residential construction. You can see it on the pie chart in the middle, in the top row. So around 30% of the market is residential construction. And the startup was saying that they plan to start from this niche, and we will agree with that because it's reasonable, because it's 1/3 of the market, and they later plan to expand to the other niches. And also we looked into the square meters and the number of units built annually in the United States, and we saw that this market was growing. So what it meant is that the niche they started from a pretty big niche which was growing, and the data penetration in this niche and in this country was pretty big. And we also validated that the total addressable market in this case was more than $1 billion. Then when you describe the problem of the client, and when you described the niche you're addressing, and calculated the market size, then you talk about the product, like what exactly the company will be doing. And the product is not only the technology stack, but also the business model, how you position and how you position it. Because like you can have a cloud solution, but you can position it for enterprise, you can position it for SMBs, and the product will be different. In some cases, it will be more sophisticated with more integrations. In other cases, it will be more simple. And for example, everyone knows Salesforce. So Salesforce was the first cloud hero. And when they started, they were on-premise solutions like SAP and Oracle, which did the same solution, and like probably they even were more or less have the same, more or less the same sophistication in terms of like similar in terms of the sophistication of the product, but the business model was different. You could like in terms of Oracle and SAP, you had to pay to system integrators to make the installation, while in terms of Salesforce, it was a self-serve solution where you could pay with a card and get the solution cheap. And again, when we talk about the business model, we talk about how exactly startup earns, because you can charge the client, for example, again, having exactly the same product in terms of technology, you can charge them like on a monthly subscription, you can charge per seat, you can charge per the volume of transactions, for example. You can charge annually, you can charge lifetime license, sell lifetime license, you can charge for integration, you can sell hardware products, etc. So in this subsection, you describe exactly how exactly you charge a client, how and like what is the product you charge them for, product or services, and what is like the average check per client, and like what is the repeatability of the sales. So you try to understand like how much you can earn from client here. Then we talk about competition, and that is a really important topic because every startup has competitors, and like an average startup has more than 10 competitors, because millions of people across the globe work on startups, and if the market conditions are right, it's very likely that many people simultaneously come to conclusions that they should start some sort of the startup. But here we need to show that the market environment still provides the ability for our startup to become the player number one, and that we are not competing against like tech giants and or some other monopolies, and that our competitors are more or less at the same stage, or they have a very different value proposition and the pricing model, and actually addressing another niche. And still, like we have a strong differentiation from them. We have a good, like strong barriers to entry, because barriers to entry, like the harder to replicate the solution, the higher margin you can charge from your charge your client. And we'll talk about this in our section in the market analysis webinar. And here is an example how you can do, for example, competitor analysis. So I typically do it as in a table form, where in the columns you can see on the left the name, no, like the startup, and then you see a couple of direct competitors and see a couple of market alternatives. And in the rows you can see a mix of business and technology parameters, which I use to compare the solution. And below you can see, for example, the reasons why I decided that this is a good investment opportunity. And please pay attention that some startups, especially when you look into the market alternatives, they could raise like hundreds of millions of dollars, and they could be on the market for 5 to 10 years. But because of their the different business model and the different niche they're addressing, they wouldn't be our direct competitors, and we still have a room for our startup. A good example is HubSpot. I don't know if you use this CRM. So despite they were like big players like Pipedrive and Salesforce, HubSpot has found the niche, and because they did a more simple CRM with which was employing slightly different business model. They started as a freemium, and it was easy to implement. It was focused on marketing professionals. It has many necessary integrations. So they had a chance to build a big company, and as far as I remember, they are even public. Yeah. So what I say is that in many cases the market alternatives could be well-established companies, but because of the different business model and the niche they're addressing, you have a chance to build a unicorn. Then one of the things which is really important to think about is the investment trends in the niche. Because when we make a investment decision, we're thinking about the exit opportunities. So what would be the can we do an M&A? Can the company go public? If so, like what would be the potential exit opportunity? I mean, in terms of the valuation. And to do that, we can look into some other deals which have been done in exactly the same niche, both companies going public and going acquired. And by the way, you can find a lot of data about like M&As and multiples. For example, at PitchBook, they get both public information and their own estimates. And why it's important? Because it also shows who are the active acquirers in niche, and it gives us an idea how reasonable is our estimate, of the exit value and the expected returns we could get from the deal. So this topic is really important. Sometimes, especially for new especially for new niches. For example, there are many niches in blockchain. Uh, you won't see many M&As or IPOs, or for example, in quantum computing, like a pretty new niche, you can't see like exactly M&As and IPOs in this particular niche. But you can find the niche which is more or less similar to what you're dealing with. For example, in terms of Web3, you can look into financial sector M&As and see how big are the companies and who are the potential acquirers. In terms of quantum computing, for example, you can look at at the niche and an activity in the cloud sector, or in artificial intelligence sector, or in more broader IT sector. Yeah, so to give you an idea of a reference class you could look into. Then we start to talk about the startup itself. And initially, you talk about like the history, when the company was established, what milestones they achieved, what is their revenue, how the revenue grew like over years, how many clients do they have, and the historical financials and like the forecasted financials. So like to set up the context where the company, what was their way before this investment, where they get now and where they plan to get, and later we will start talking about where the company plans to get in the future. Then you have a separate slide of financial projections. Typically, people look at revenue, EBITDA, burn rates, and some other metrics. The client growth, churns, LTVs, LTV CAC ratios. So at this slide, you try to understand, like, first of all, see the historical aspect, how the company developed business, and then you look at the projections for the next five to 7 years, and try to validate whether these metrics are realistic. On one hand, they should be aggressive, but on the other hand, they should be like realistic. For example, it would be too aggressive to suggest that the company will acquire like 50% of the market or 70% of the market. So typically we would suggest that they will acquire around 10% of the 5% of the market, 10% of the market. But on the other hand, this revenue in 5 to 7 years should be like sufficient enough to sell the company, like to reach, for example, $100 million, $100 million in revenue, or so on. And given the multiple, like 5 to 7, like 5, 7, 10x, you can sell this company for like $500 million, $1 billion, and so on. But we will talk about the scenario analysis a little bit later. Then, when you made financial projections, you need to validate those financials for projections, at least for the next 12 to 24 months, because this is the time span when you will be when the startup will be spending your money, and this is the period which is more reliable in terms of the forecasts, rather than like the forecast for like the next 5-7 years. So we pay more attention to the first half of the year, the first 12 months, the first 18 and 24 months of those forecasts. And if it's a B2B company with pretty long sales cycles, then we look in the customer pipelines, and we have a chance to talk to get the customer feedback, and to make us more comfortable that given the feedback and the customer pipeline and the number of customers which are like in the process of signing the contracts, that we can close. We can meet the revenue forecast we did in the previous slide. Then a very important topic is the team, and the team is crucially important at seed, pre-seed, seed, and Series A stages. It's also important on the later stages as well. But like as the company grows, it becomes more sophisticated in terms of the management, in terms of the like C-level managers operating, and later stage investors are paying more attention to the financials rather than the team. But the team is really important. Anyway, a classical team at the early stage is a combination of hustler and hacker. So the hustler is a CEO who will be pitching, like making sales, pitching to investors, partnering with other companies, and so on. And CTO is a hacker who is building the tech. It's not like having a CTO is not relevant for all the business models, because in some business models, for example, if you're doing a machine learning company, having a good CTO is crucially important. While if you're doing, for example, a delivery service, or I don't know, a car sharing company, a startup, it's more important for you to have a good execution, because it's a very operational model. While you can use like third-party solutions for your tech, and in this case, you pay more attention to having good operational and marketing officers rather than a good CTO. But anyway, here is an example, like kind of a joke, how you can describe how you can describe the team, the key core team members. And first of all, you of course pay attention to those people who have the higher share in the companies, the co-founders. Okay. Then we talk about the current round, and first of all, we talk about the round size, the burn rate, or the runway, and here we need to make sure that at least the money which the startup is raising will be sufficient to support the company during the next 18 to 24 months. And now we're recording this video in January 2024. So the VC market is like in the downtrend, and VCs prefer to invest companies with a path to profitability, and like prioritizing profitability versus growth at all costs. And here is a bad example. For example, a company is raising money which will be sufficient to support it during the 9 months. And that's a very bad strategy, because in 3 months, they will need to start fundraising, but they won't have sufficient revenue traction to close the new round. And like if they raised money sufficient for the 9 months, it means that in 9 months you will be making a follow-on investment, because it's very unlikely they could secure money from external investors. Here is benchmarks. Here are benchmarks for funding round at pre-seed to Series B stages, which are relevant as the end of 2023. You can look into like how the company looks like, what's ARR, what will be the ARR necessary for each stage, what would be the valuation range, how will team and product look like, and so on. Then we talk about the go-to-market strategy for the company, how they position their product, how they plan, what the niche they first plan to address, what will be the next niche they plan to expand, or there are oftentimes, especially in SaaS business, companies sell one module and then they increase out-of-the-pocket expenses, providing like additional modules, and have the negative revenue churn because they increase because they increase out-of-the-pocket expenses. So at this section, we discussed the how the go-to-market strategy, and try to validate it, try to make sure that we believe in this go-to-market strategy. Then after we talk about the business development, we also talk about the product development roadmap, because if you expand to the new niche, if you upsell your clients, you need to expand the functionality of your product. And this is the section where you draw a Gantt chart and show what modules at what stages you plan to do. Yeah. Then you talk about the deal terms. So again, you say talk about the size, the investments, your ticket in this round, the valuation, liquidation preferences, etc. How those money will be spent, and so on. For example, here is the deal example for an equity deal. For example, the round is $5 million, 3.5 are coming from the lead investor. Pre-money valuation is $20 million. And there will be first closing and second closing. For example, the lead investor together with some other investors will invest I don't know, $4 million, and you can make a second closing during the next 6 months, raising an extra $1 million. Yeah, and for example, you're building a board of directors, and ideally the board of directors should have less members than the less members the possible. So minimum investment board of directors is one representative of a fund, one representative of the company, typically it's a CEO, and one independent director, which we both agree to hire on. And typically this is an industry expert, which helps us to get insights and balance our decisions. And there could be other terms like liquidation preferences, but we will talk about this in our next webinar, where we'll be talking about term sheet. Then, of course, we talk about the return on investments. There are different ways how we can calculate that. I'll show you, but typically it all involves various scenarios and calculating the IRR for each of those scenarios. This is an example of Bessemer return on investment analysis done for Twitch. You can click to the link below and read the whole investment memorandum. But as you see, they have 6 scenarios, and in each scenario they forecast the exit value, the price at which they plan to sell the company. Then they forecast the date, the year, the quarter they plan to sell the company, and then they forecast the probability of this scenario. How they do that, I don't know exactly, but I suggest they do this way. Bessemer has hundreds of companies in their portfolio. They seem like, I don't know, hundreds of thousands of startups over their long career, and they have some historical statistics in their portfolio. How this how likely is the scenario, each of the scenario And I believe they also have some researches in terms of like some averages on the market. So they use those probabilities for each of the scenarios, and then they look into the terms of the deal, because in some cases you can have participate in liquidation preferences, in some cases you can have some other terms which affect your the share, the final ownership of the company, which you will have based on the scenarios which we materialize. And then they calculate how their share, like they multiply the valuation of the company by the share they have in each scenario, and the money they can get by based on the terms. And so they calculate the money they get during in their exit, and then they calculate the IRR based on the how many years will will pass after their investment, and calculate the IRR, and then they calculate the average IRR and average cash and cash. Then we also show the cap table, and we have a separate webinar on the cap table calculation. It's not that sophisticated, but you need to account for many things. What we need to make sure here is that the cap table looks healthy, based on is in line with the benchmark for the existing for the current state of the company. Because at each stage the startup founders got diluted and have lower and lower share, so we need to make sure that they have their stake is big enough to motivate them to build business. Here is a bad example I've came across. A business angel gets 75% of the company for $200,000 investment, and even at like a pre-seed stage, the team has only 25% of the company, and it will be diluted later. So it doesn't motivate the founders to run this business and work for it for the next 3 years. Here is the example of the cap table. So we typically show, for example, like the ownership, the ordinary shares are the shares of the shares which belong to the founders. There is an ESOP. This is a motivation option pool for employees. And there are also the owner, the share of the Series A investors, and then we do the calculation. This is in the second column. In the third column, you see the ownership of the company before the Series B investment. In the last column, you see the ownership after Series B investment. Yeah, these tables, they could be really sophisticated, like with dozens of rows and columns, depending on how many rounds of investment you had. And why it's really important to calculate the cap table, because at some point, at earlier stages, you have safe notes and convertible notes, which don't have share in the company, but as soon as they get funding later, they will be converted to the shares of the company, and the team will be diluted. So you need to understand what would be the future ownership of the team and the investors when this like conversion event happens. Then when you do a deal, it's not relevant for pre-seed deals, but starting from seed and on, typically at least lead investor makes a due diligence. And it means that a VC hires a legal and tax and financial advisors which check your which make a due diligence on your financials, taxes, legal structure, etc., and also write to the transaction documents. And for example, it could take like for example, if you're doing a $2 million round, the people could charge you, the providers could charge you like $40,000 per transaction. So it's a pretty costly operation. And when you do due diligence, you can also get the commercial propositions from various providers, and also make a decision which of the providers you will take, which you will hire to make a due diligence. And also, the last but not the least, all startups are associated with risks, and you will always have a risk reward map, and you also talk, for example, why you believe this risk is acceptable, or if this risk materializes, how we will be managing this risk. So what's your plan B? For example, this is the example of risk battle card from Bessemer Venture Partner when they invested in Twitch. You can read it later. And then we, at the very end of our presentation and on our investment memorandum, we have a small subsection with our conclusions and recommendations, where again we repeat the deal terms, the key points why we love the deal, and our recommendations. And of course, our recommendation is to invest in a company because, as I said, it's really time consuming to put together a memo. But the discussion at the investment committee will be around the terms. Probably we can suggest like decrease the valuation, or we could suggest doing tranche investments and KPIs, or we can or we can suggest like which to decrease our exposure in the deal. Yeah, so this is here we finalize this section. Now let's talk a little bit about the reasons startup fails. And here I take the insights from CB Insights. You can see, you can check out later the whole report. But if you look into this graph, you see that the one of the main reasons is there is no market need, and the reason for that there could be several reasons for that. First of all, it means that the startup is too early to invest on, or it was a reasonable suggestion why it could work on, but for whatever reason, the market doesn't need a solution, or the niche, like the real niche, was way smaller than the investors initially suggested, or like the average check of the market, that average check was too small, and too small to to make the unit economic work. The second reason startups fail is that they run out of money, but typically it means that they have problems in terms of the developing business, and the running out of money is like the consequence. And the third reason startups fail is the problems in the team. and it's a really stressful for VCs when, for example, CEO leaves the company, or there is an internal conflict and you need to manage it. So, and this is why, especially at the early stages, VCs pay so much attention to the team. And the fourth reason is that the company was outcompeted by the other players, and especially this is relevant for the niches with low barriers to entry, and this is why we pay a lot of attention. A lot of attention, like what's your secret sauce, how you're different, what are the barriers to entry. Yeah, and there are like a set of other reasons, but they are less relevant. And here are the reasons for success of the company and the founder. But typically, it's associated like with having a more experienced team, with the team which is flexible, which iterates fast, which gets feedback, makes pivots, and so on. And there is always cool to look into some companies and especially how they fail, because many people try to learn on the successes, while in reality you need to learn on fails. And here is a company called Martin Mark. It's some sort of data company providing insights about the startups. So what I did is, you see the green graph. This is the head count of the company, and the yellow graph is the website visit. So they're providing a B2B SaaS solution, web-based. So like the website visit is proportional to the numbers of users and paying users. So it's kind of shows the dynamics of the business itself. So what we can see here is that the company was a alum of Y Combinator. Straight after the batch, they raised $1 million. Then they raised in total $17 million. And 6 months after they did a Series B, they started to fire people. And we see that their revenue also, that their website visits were also falling. And finally, the company was acquired for $1 million. So it means that like investors didn't get their money back. So this is an example. I didn't dive deeper into why the company failed, but I believe that one of the reasons is that the data they were providing were not like sophisticated enough for the users to pay for them. Yeah, but this is my personal opinion as a potential user of this platform, because I used free trials, but I never paid to them. Now we will be talking about the next subsection, how investors make investment decisions and what they pay attention to. So we will elaborate a little bit more in depth the topics we discussed in our investment memorandum section. And here I use the investment seed framework. You can see the link here, because I believe it's really cool. So we will go section by section and discussing everything in this framework. So first of all, it all starts with analyzing the market sizing. And you need to make sure that total addressable market is more than $1 billion. And as you remember, we suggest that the company will, acquire 5 to 10% of the market. So it means that the company could build a business with like $50 to $100 million, and could be potentially sold for like, I don't know, $500 million to $1 billion, and so on. So this is why it's so important to assess the total addressable market. The other thing we pay attention to is if the problem is real and validated by customers. Because I've met a startup who had several millions of users, free users, but when they wanted to charge the users $10 monthly, like none of them subscribed because their solution was a vitamin and not that essential to them to pay for it. So this is why it's really important to validate that customers are already paying either for your product or at least for solving the problem you're addressing to. They could be paying either the market to market alternatives or your competitors, and there is a reasonable suggestions that why those clients will be paying to you, but ideally you already have the paying clients. Then you also try to show that like the product is vitamin, it's not vitamin, but it's a painkiller. So it means that like the clients utterly need your solution. And a good example here, and why it's important, especially during the downturns, because when the clients optimize the costs, first of all, they unsubscribe from inessential solutions, and it means that your business will be at risk. Then, if your solution is not essential, that it will be harder to sell, the margin will be lower, the marketing costs will be higher, and the sales cycles will be lower, and all in all, unit economics will be poorer for vitamin products versus painkiller products. So this is why we pay a lot of attention to that. Then there are a set of questions about the solution. First of all, we ask question why founders do what they do, how did they came across the problem. Ideally, that the founders had experience in the field, or this problem arose from their personal need. Why is that? Because they understand, they better understand what they're doing, and they have a strong motivation to do what they do, because it gives us like the perception that they will succeed in it. Then when we talk about the solution, is there an evidence that the customers like it? Ideally, if they're already paying for it, if they pay, and for example, if it's a subscription, what is the churn rate? And for example, if you have a like 5% monthly churn rate, it means that in 6 months you will 60% of the clients will leave you, and this is it's a disaster. While if you have 1% churn rate, for example, monthly churn rate, it means that after 12 months you will have 88% of the clients using your product, and this is a good sign. So anyway, you try to get here any validation of that clients love your product. Then when we talk about the competition and the product, there is a mantra that your product should be like way better than some other solutions, like 10x better, 5x better, 2x better. Why is that? Because like if you provide a solution which is more or less the same as your competitors, then it will be hard for clients to switch for them. Like why bother? While if you're providing something which is really game changing for a client, they are more open to change their behavior, to pay for it, to switch from one provider to another. So this is why we pay so much attention to that. Then I have a lot of people in this course who are outside the US, and the problem with the many geographic markets is that the local market is too small, like it's way lower than $1 billion, and you can't build a unicorn on the local market. So in most of the cases, even in such companies like in countries like United Kingdom, you need to expand globally. And when you will be talking to a VC, they will be asking you about like the next country you're going to expand to, and ideally you need to have some first signs of business development in those geographies, or you could participate in some acceleration program which give you access to like potential clients in those geographies. So like you need, first of all, you need to target big markets, and then you need to get to have the first signs that you already did some expansion to those markets. Now there is a subsection about the market. As I said, like again, is the market like big enough to build $1 billion company? Then we talk about the trends, and the quick question we try to answer is why like 2 years before it was too early to start the business in this niche. Why, like in several years, it will be too late to run this business? Is the market, other trends are right to run this business right now? Is the market is crowded, or is other very few players on it? How fast is the market growing? And so anything which helps to prove you that if you invest in a company in this niche, this company could become like $1 billion company in 5 to 10 years. Again, one of the most important questions, why now is the right moment? Because there are two factors of success for a startup: the right timing and the good execution of the team. And many startups fail because of they were too early to the market or too late to the market. So answering to this question is very important both for entrepreneurs and for investors. And the last section is what's your go-to-market, and what do you have some advantages? For example, you have an exclusive partnership with like some player, or you have an exclusive access to a database for like your machine learning models, etc. Then there are some questions about business models. The first one is how realistic are your assumptions in your business models? Because founders are often optimistic, over optimistic, and think that like they could absorb like half of the market, while in reality, like it's more reasonable to us to suggest that you can acquire only 10% of the market. Again, founders could be really optimistic about LTV CAC ratios, and very optimistic about like the check growth, the customer acquisition cost decrease, about some other parameters in the financial model. So you need to validate all the parameters in the forecasts. Then when we talk about business model, you should look into if the business model have built-in network effects. So what is network effect? Is it means that the product or service of a company has more value, like the value of the product grows with the number of the users. And the classical network effect is social networks. The term initially started there because the more users a social network has, the more content is created, the more friends you have, which you connect with more people online, and you can get more from this conversation, from producing content to that. But there are other business models which have strong network effects. For example, if you're a marketplace, you have very strong network effects, and having strong network effects results in building monopolies in some niches. So this is why entrepreneurs, this is why VCs like that. And building a monopoly, as I said in my previous lecture, means that you have a higher profit margin for a product. But not all the business models are have built-in network effects. For example, if you're doing a SaaS business, CRM, for example, the network effects are pretty weak. So having network effects is really cool. But if there are no network effects, it's not like the deal breaker. Then there are a couple of questions about the current round. First of all, you answer the question if this round is meets your investment criteria in terms of the size, the traction of the company, the check size you're investing in, the potential ownership of your company you will get. For example, someone would say, I would like to have a position in the company no less than 3% or 5% or 10%, etc. Then the question is, what is the valuation or market cap, and can we earn enough? Because sometimes the market size is too small to build a unicorn, or in some cases, like the valuation is too high, and it means like there's a very low chance that you will double your valuation at the next round of investment. Then you also talk about like the subsequent funding requirements. For example, so you essentially try to answer a question: if the company needs the next round of investment after your round, are there any investors which would like to invest in the company? And in many cases, like there are many niches, for example, 3D printing, where it's so hard for startups to raise money, just because like the moat is not in the niche and investors don't like investing in it. Sometimes this changes. For example, for most of my career, investing in drone solutions wasn't sexy, because like in around 2014 and earlier, there was a big hype around drones. Then many like drone companies lost the competition to Chinese DJI and others, and the investment idea didn't play out well. And in general, it was so hard for drone producers to raise money. But during the last couple of years, the idea became more viable. So the tide sometimes changes. But when you make a decision, you try to assess, like, if my company I am backing will need the next investment round, can they raise it? And if the answer is no, then even if like the entrepreneurs are good, even if some other parameters are good, probably it's a good idea to pass on this investment. But there is like no strong, like, you decide for yourself. But it's reasonable that you either make follow-on investment yourself if it's in line with your investment criteria, or like you will end up in the position where the company will die. They will die because they can't get funding. Then we talk about value creation. And like value creation means how much value the users can get from the from the product, and how it will be and like it all results in the profit margins of the company and like the valuation at the exit. So first of all, you try to understand if the company has some defensible technology, some know-how or patents, or some stellar team. Especially, it's relevant for deep tech companies like someone who is doing like quantum computing, pharma, bio, and stuff like that. Because this answer to the question why it's so difficult to replicate the solution. Then the other question is how the company can the company benefit from some existing community. For example, if you know the story of Facebook, they started expanding their solution through campuses and colleges, or if you're investing in Web3, for example, oftentimes, look, in most of the cases, all the products, they have the communities which are like early adopters of the solution. And sometimes even you start your community first, and then you build the solution based on the insights from the community. And then we talk about how much value can be captured from the solution. So, based on the value, how valuable the product is, depends, like, will the client be paying like $2 or $200 for something. And if there is like the rule of thumb, if you save like $100, or if you bring new revenue, $100 of new revenue to a company, then you can charge 10% of that. So you can charge $10. So based on like the value you create, based on savings or new revenue streams you create to the company, you can assess like the potential ticket you can charge for your solution. Then again, let's talk about competition. First of all, like again, the barriers to entry, and there are many niches where the barriers to entry are very low, like for example, scooter sharing. And if the barriers to entry are low, that it means that the winner will be the company which raises like the most, like the biggest rounds of investment. And it's really hard for investors to pick the winner in this case. And for example, when I was during my career, I saw how the company BERT developed. The company raised like billions of dollars, and last year it went bankrupt. So, and this what means what could happen if the barriers to entry are really low. And the other question you try to answer: are you competing against like big incumbent players like Amazon, Facebook, and others, or you're competing against like many small companies, or for example, good markets for marketplaces is if the market consists of like thousands or like millions of small companies, and there is no clear winner here. And then like platform like Amazon could aggregate the demand and build a monopoly on the market. So try to understand if you're in such position. Then we answer the question, like a set of questions about the exit. So first of all, try to answer why the company which we're building will be acquired. For example, if you're building a pharma startup, probably like in in most of the cases, your company will be acquired because of your unique team and IP you created. In some cases, the companies are acquired for their business. For example, you have business in some geography, and some corporate is expanding to this geography, so they buy your solution for the business in this geography. In some cases, company could be acquired for the product. For example, WhatsApp was acquired. They had a pretty big client base, but first of all, it was acquired for the product, and Meta the Meta was thinking that based on the client base they have and the products WhatsApp provides, they can scale this business dramatically. In some cases, the companies are just acquired because of the team. For example, it's typically an acqui-hire, and it's a bad investment strategy to invest in startup, thinking that it will be acquired for the team, because it's like the lowest valuation you can get. And in many cases, for example, if you're building an IT or ML company, in many cases, like the IP strategy acquisition idea would be also not lucrative. While in some cases, like pharma, IP acquisition is a standard for the market. Then when we talk about M&A, we talk about what are the metrics which will matter to the investor. And typically, this is a combination of revenue and EBITDA multiples. Sometimes portfolio size of a patent portfolio matters. Some clinical trial milestones, some key clients, something like that. Yeah. Then let's talk about the risk profile. There are many risks which are associated with the startups, but one of the risks you always take is the business risk. So the market risk. So first of all, you take if the market will grow or not. This is just your judgment, and then you pay and pray. And the other risk is what you take is the execution risk of the team. So you either believe in the team or not. You can do something with this risk, discussing with the team that, okay, we will hire C-level managers, which will increase the chances of success. But you're limited here, and you in general you always take this the business risk. So the risk that this business will work or fail. Some other risks, for example, regulation risk or ecological risk, or other risks, you just assess them, and you can proactively force the entrepreneur to deal with this risk. For example, if there is a regulation risk, and you see that some points should be done, then you can negotiate with the entrepreneur so that they either do it file some documents and do paperwork after the round or prior to the round. But anyway, the one thing we need to remember is that we need to take risks, and sometimes there is a temptation to decrease all the risks. But the problem with that is that yes, on one hand, you need to decrease the risk if you can decrease those risks, and if it's reasonable to decrease those risks, like for example, a risk associated with regulations. But in some cases, you just not only can't decrease the risk like a business risk, but you should be willing to take this risk, because if you remember from our previous lecture, taking a risk, you remember this risk reward curve. So the more risk you take, the higher the returns. And if you de-risk all of the risks, then you wouldn't, like your returns will be small. You will be actually not in the VC business. So on one hand, we de-risk. On the other hand, ask yourself, do we take enough risk so that we could get exceptional returns? And when we talk about the risks, we always ask ourselves, are we investing in a moonshot company? For example, think about SpaceX. When Elon Musk started SpaceX, it was a great idea of building a private company which will be launching payload to space. It was crazy because you were competing against government contractors, against government companies. But if it worked, and there were like probably were reasonable ideas why it will work in the future, it could be a really huge company, a really huge company. And this so always think about that always remember that venture capital is the business about outsized returns and huge risks. So for you to understand, like only 5% of the portfolio develops like exceptional exceptional rewards. So you can get like from a single transaction, you can get like money which will be 2 or 3x of your fund, total fund. And the single deal significantly out of 20 deals you do in your portfolio, only one deal makes a significant returns, which makes drives the positive return for all of the fund. Then, as I said, we pay a lot of attention to the team. And that there will be 3 slides about that. Let's look into that in more details. First of all, we try to understand, like, is this the team number, like the exceptional team? Does the team have unique advantages? Why they can overcompete others? So with all things equal, we would back the second-time entrepreneurs, like biggest experts in the sector, people from VCs or in investment banking who have a broad network of experts, who can hire people, who can raise money, etc. The second question is, do they have some market insights, some secret sauce? And for the industry experts, it's always the case. For example, you had 10 years or 20 years in the industry, you understand it like really well, and you understand the trends, and you understand some insights from the other industry players, and you build business on top of that. Then the other question is, do you as a VC trust to the people, like to the team of the startup? You can't quantify this. It's just the gut feeling. But when you spend your time, like years of working in venture capital, this gut feeling will be providing you with more like relevant insights. So sometimes, even if the team like pitches perfectly, even if the other factors are pretty well, but you don't trust or don't like the founder for whatever reason, probably it could be a good reason to not to close the deal. The other question you typically answer, and personally myself, I believe that building a startup just to earn money is not is not a good motivation. You need because like it's a very tough journey. You will be building this business for more than 10 years, and there should be more than just earning money when you start your startup. You should have some mission. You should have some reason. You should have some noble purpose why you're building this business. And by the way, I have a separate course. It's a paid mentorship program when I help people to find the idea for startup and launch the startup. So we do a lot of exercises, which are at the very beginning to find some idea, which is in line with your personal mission and the business trends and the trends on the market, and you have high chances of raising your money. So when you assess why someone is doing business, try to understand his or her intrinsic motivation. And on one hand, if the person is mission driven, it means that they will be, running this business. They will try everything to make this business successful. But there is a flip side, of course, is that at some point you need to kill the business, and if the person is very mission driven, they will try to save the business, even if it's time to let it go. But all things said, having a person which is strongly motivated and having a reason why they're doing business, this business is better than investing in someone who wants only earn money. Then we need to answer a question like, do the people have can lead and can hire fantastic people? Because it's really important when you make your first 30 hires, because this if you hire cool people which are joined with which have very very strong mission, then you can you will build a corporate culture which will drive the growth of your company. And those people, the startup founders, they will need to scale teams to hundreds and thousands of people, and they will need to hire high quality professionals from corporates, from they should get the exceptional talent, and they should persuade them to join your team. And for example, Steve Jobs hired John Scully from Coca-Cola. Yeah, so this is why the leadership and the access to the talent pool and the ability to hire people is extremely important for the success of the company. And you try to assess if this person is capable of doing this or not. The other question you answer, are they commercial? Can they sell? And typically at earlier stages, the CEO of the company is the first sales representative of the company. And you try to assess whether you believe or not in his or her ability to sell to the clients, to sell to partners, to sell to other VCs. And of course, the indication of the sales capabilities are, first of all, the previous experience in sales or the previous experience of building a business, or if they could secure some good contracts, some good partnerships, some good pilot projects within the existing business you're backing. The other question is do they understand well the market and the competition, the product they're selling? And the best entrepreneurs I've met, when you ask them anything about the market, they have so many insights. And when you ask them about the competition, sometimes they can even send you the pitch decks of their competitors, because they try to deeply understand what's happening on the market. Who are the best players? How they're different? Why they believe they will be better? So they very deeply understand what they are doing. And the last question in this subsection is, do they have big ambitions? Because and oftentimes you can see those ambitions when you look at the projections of the company. For example, you see the projections saying that in 10 years we'll have $30 million in revenue. $30 million is not a high revenue in 10 years. But but on the other hand, you can see a person who says we will have $1 billion revenue in 4 years. This is also unreasonable. So when you assess when you assess a team, you try to understand, like, are they ambitious enough and are they reasonable enough in the size of the business they are planning to build. And the third subsection about the team is, first of all, do they do they get as a group? What it means? Like, do you believe that they will the team will be sustainable? And oftentimes, when you successful teams, the co-founders have a previous backgrounds of working together or building business together or studying together, or like they have been friends since they're kids. So some proofs that they work well as a team. Then there is a diversity thing. Um, one good thing about the diversity, I mean, the people, having the people with various backgrounds in the team, is that people with various backgrounds have unique points of views on many topics, and the solutions they make, they will be also more diverse. And um, you know, I once heard a good idea. So if you want to get exceptional returns, you need to find outliers, and you need to find a unique way to find those outliers. And this diversity things, the diversity thing, like having people with different backgrounds, is also about getting outliers and getting some opportunities which others miss. So think about it. Not over optimize about this diversity thing, but think about it as well. The other questions you try to answer about the team is, what are the gaps in the team? What are the key hires you need to do after the closing the deal? And and here you need to discuss it with entrepreneurs, how they plan to close those gaps. Do they see those gaps themselves? Do they believe that they need to close this? And what's the strategy to closing them? Sometimes VCs help to make key hires. Sometimes they can refer to some HR managers who could help to close those gaps. Sometimes you interview C-level managers together. For example, the entrepreneur picks the person he or she would like to hire, and then say, okay, I would like to hire this CMO, and what do you think? And lead investor could also have a chat with the person and say, okay, yeah, I'm okay with that. It's not mandatory that the VC puts freezes on the hire, or like could ban some specific person. It's just a second opinion. And finally, the last but not the least is how humble and willing to listen the entrepreneurs. It doesn't mean that, like, the entrepreneur shouldn't blindly do whatever you say to them, especially as a VC, because VCs are not entrepreneurs. VCs are investors after all, and not all the insights we have are useful for the business. But this ability of a person to listen to the feedback from the real world and to reflect on that and to make decisions based on this feedback is a crucially important capability of a person. And for example, I once talked to an entrepreneur, and I said, like, why don't you expand to this niche? It sounds really interesting. And the entrepreneur said, we haven't I don't have a question, the answer to a question right now, but give me a couple of days and I'll come up with an answer. And he went, did his research, talked to his team members, and said, okay, it's not viable because this, and this. And that's what a good entrepreneur should do. We finished our second section, and let's move to the third one. This is a very important section because we will be talking about paradoxes and biases which venture capitalists face. So venture capitalists are also people, and as with all the people, we make mistakes, and sometimes those mistakes are irrational. So you'd better know about them. I read a pretty good article. You can see the link here. You can read the full article here as well. So, as I said, we as venture capitalists, we like do many mistakes. And one of the reasons for that is that because we deal with extreme uncertainties and asymmetry of information, and we need to make decisions fast. We don't have enough information to make those decisions, but we need to do those decisions fast. And for you to understand, like, out of 200 deals you get, you make only one investment decision. So you need, and for example, Y Combinator, out of 40,000 entrepreneurs, choose 200 in a batch. So you need somehow to filter those immense flow of people and ideas and startups. And this is why VCs often use various heuristics. So this is some rule, some simple rule, which helps you split and filter out many deals. And when those heuristics emerge, they are very reasonable. But sometimes the situation changes, and those heuristics also change. So you need to keep in mind that it could happen. For example, for years, the common market sentiment was that now we don't invest in the drone companies, and there was a reason for why was that, because the regulation was not in place, and stuff like that. But the last couple of years, the market conditions changed, and now drone companies raise money. And the other thing, as I said, we work in the environment with a strong asymmetry of information. The entrepreneur knows much more about the company than VC can ever get, even if the venture capital do due diligence. So this is the second factor you need to understand. And of course, this factor affects the quality of the decisions we make. Then I previously said about this in our previous webinar, but I want to stress that venture capitalists have a very long learning cycle. Why is that? First of all, typically a VC, a partner of a fund, doesn't do many deals a year, depending on the stages. So if it's a Series A investor, like a partner could make one deal or two deals annually. If it's a seed round stage, a partner could do like 5 deals a year, 2 deals a year, like 10 deals a year, but like 10 is a maximum. Then it takes you a couple of years to see the results. So as I said, typically startup raises raises each round in 18 to 24 months. So you will the first results you will get faster in case the company didn't play out well. But finally, you will see how the startup works, if the idea worked out or not, like in 5 years from your investment, or in 7 years, because the startup even can raise the next round but at some point something happens and the company dies. And the third problem and temptation is that VCs would like to stress their successful cases, and oftentimes they underestimate the good luck that helped them to exit the company. While to learn on to really learn something, you need to learn on your failures. And this is actually the reason why the reasons why first-time managers typically perform poorly compared to experienced VCs. And if you, for example, plan to build your own VC, hire a person with experience in venture capital, at least, because they have already went through this learning curve, and their decisions will be made better than you, just because you just start your journey. So let's talk about some biases. So first of all, there is an example. So suggest that some person is very humble, so very shy, and don't like to talk to other people. And suppose you meet such a person. The question to you is this a person a librarian or a farmer? And in many cases, people will say this is a librarian. But in reality, there are 10x more farmers in the United States than librarians. And the farmers could also be shy, could also have this behavior. So the first bias venture capitalists have is ignoring this statistical information. And the statistical information for an investor is that out of 10,000 startups, you can find only one unicorn, 1, 2, 3. So, and if you meet a startup and you believe that like this is the best deal ever, like statistically, it means that it won't become unicorn. It could be a good company. You can sell it for $100 million, but like getting a unicorn is a very good luck. So just keep it in mind when you make decision and when you see like the best deal ever. The second bias is availability of the information. And what it means is that we tend to overweight the information that comes easily to our mind and underweight the information which is relevant but less exciting. For example, we see many times subconsciously ask themselves how this entrepreneur is similar to the entrepreneur which was successful in our previous investment. So we unconsciously looking for and make these judgments on the similarity basis. Or, for example, you love the idea so much and want to make the deal so much that you start to ignore the less exciting information, like about like churn, high churn, or losing a client, or like negative feedback on the something like that. So make sure, so when you make decision, that you're not underweighting these negative signals you're getting, that your decision is not based on emotions or doesn't have such biases. The other bias is overconfidence. I have many smart people around me, and a smart person believes that he or she is really smart. And we tend to be sure in what we in our judgment. We are tend to be overconfident. So the guys in this book in this article made an exercise. So they took 51 VC and they took real historical deals which were made. They removed all the information so that people couldn't identify the company, and then they provided this information to the VCs, so they made investment decisions, and they asked the question, so like, will you invest in a company, and how sure that you are making the right decision? So what you see is that regardless of regardless of the fact that the company was successful or not successful, and regardless of what they made the right decision, the VCs were very confident in their decisions. So um, so remember that. So we can make mistakes, and remember that you are not the smartest person in the room, because otherwise you could face problems of overconfidence. The other question, the other bias is informational overload. Um, you know, as I said, like very smart people, can reasonably prove anything, anything they believe. And at some point, when you make make a analysis of a startup, you had so much information that any additional information doesn't make your decision better. So at some point, you just need to stop and make a decision. While if you you can spend so much time getting deeper and deeper in your research, and it doesn't improve the quality of the decision you make. The other bias, I already told about it, is the survivorship bias. We naturally tend to look at the success stories and reflect on the success stories. But in the reality is that most of the startups fail. And if you want to learn on something, you need to learn on those startups which failed, and try to understand why they failed. Reflect on that. The other basis is similarity basis. Investors are human, and as every human, we tend to prefer talking to the people we feel comfortable with. Tend to talk to people which we like. For example, if you're an engineer, you would prefer talking to an engineer. If you're an MBA, you would think that people with MBA are the best entrepreneurs, and so on. This is a hint for the startup founders, because all investors are prone to this similarity basis. So if you're a startup founder, you could approach the partner in a fund which has the most relevant background to you. Because of this similarity behavior, the bias, they would be more willing to take take a call with you, to talk to you. But this plays this decreases returns for investors. So remember about this. Don't underestimate the founders which have a very different background than yours. The other bias we have is called confirmation bias. So we prioritize the information which supports our solution, and discount the information which makes us feel uncomfortable about the decision we made. Why it's important? Because, for example, if you made an investment in a company, and the company underperforms. And there are signals the signals that like it will end up badly. And in many cases, just because you already made a decision about investment and you don't want to lose money, you try to find positive signals, some positive signals in order to like make a follow-on investments. And it all ends up in many follow-on rounds, which end up finally in the bankruptcy of the company. So beware about this bias, and keep this in mind when you're dealing with companies which are underperforming. I'm not saying that you should be ruthlessly killing those companies, because there are many cases when the company face problems and they survive, and become successful. But be aware about this problem, and make sure that you're not discounting the negative information when you're making your follow-on investment decisions. And there are some tips how you can compensate on those biases. For example, you have a deal which all in your room, all the VC, all the investment committee members like. And in this case, you can use a pre-mortem approach. So you say, okay, guys, we invest in this company and it dies like in 3 years. We know that it dies. And think about the reasons why it happened. And this post-mortem, pre-mortem approach, makes you be more creative and try to look for intrinsic risks which you didn't pay attention to. It doesn't mean that you don't need to, you shouldn't invest in this company. It means that you can identify those risks which you didn't pay attention to, and then you can discuss in a group if those risks are acceptable and are you willing to pay to take them, or you can discuss the mitigation strategy to dealing with these risks. The other tip is the reference class forecasting. Remember, I talked about the drones. For example, you can come across exceptional entrepreneur, brilliant idea, but if you look into the niche, you see that there are so few startup founders which became unicorns because of the intrinsic problems of the market. So how this works? Try to find a typical reference class. For example, a startup came which is doing some B2B marketplace. Okay, you look how B2B marketplaces for example, in the United States in general played out. Just look at hundreds of marketplaces. Are there billion-dollar companies? Are there $100 million companies? Which of them were successful? Then think about the typical outcome for this class. So in case of the marketplaces, yes, there will definitely be unicorns. If, for example, you're dealing with a marketing tech startup and you look into those 8,000 solutions which already exist on the market, you will see that very, very few of them were sold for more than $100 million. So even if you're investing in a brilliant company, the chances that it becomes a unicorn are really small. And then try to understand, based on this information, trying to understand what will be the potential outcome for your company you're planning to invest in, and try to think about the reasons. If you believe that it will be better than the reference class, try to give the reasons why you believe so. And the third thing is use heuristics wisely. As I said, heuristics are very important because they help us to make decisions fast. And in many cases, they work perfectly. But sometimes heuristics change. For example, and they emerge because for some reasons, for some business reasons, for some market reasons. But sometimes the premises based on which those heuristics emerged, they changed. And over time, you need to revisit them. For example, for many years, it was a good idea not to invest in the edutech companies. But like if you looked into like into pandemics deals, there are many education deals done just because some premises changed. So remember about this. Ask questions why we're doing something or we're not doing something. Why we are filtering out this type of the companies or that type of the companies. Revisit those premises. And there are some other interesting articles I would like to advise you to read and talk a little bit. So again, as I said, like if you're investing on a like similarity basis, so typically your returns are lower. So for example, if you're backing a small group, for example, alumni of your university, you're limiting you're limiting your the flow of the deal flow to like very small subgroup of people. For example, like a typical university has like 10,000, 50,000 people, like alumni, like 100,000 people. And on one hand, the university made a filtering because like the acceptance rates for Stanford, for example, is 0.5% of the people. Like, so on one hand, a university could be a good filtering, but on the other hand, if like the university is small enough, then you will be missing like the number of the deals you could be dealing with is really small, and your returns are going low. And this similarity basis approach also makes the returns lower in some other types of filtering. For example, if you're like invest only in the like some ethnic groups, it could if the group is pretty big, that will be your advantage. But if the group is really small, then you will be losing money. And exactly the same if you're evaluating the startup teams based on the background. Then there is a notion like you need to invest in second-time founders, and there is a good article where they looked into and compared second-time founders versus first-time founders. And first of all, even if you're investing in a second-time founder, the chances of them succeeding in their next venture is not 100%. Like it's close to 30%, just because of the nature of the venture business. So they can fail not because they have poor execution, but because it was not perfect timing. Even like serial entrepreneurs, like not all of the businesses succeed. And if you failed your previous business, actually the guys in the article showed that the chances of succeeding in your next venture are more or less the same as as the chances of the first-time entrepreneur. Like, it's probably counterintuitive, but this is what the people learned from the data they get. So not overestimate this experience of being a second-time founder. Then there is another idea, especially among entrepreneurs. Then the stronger the brand of the VC, the higher price they pay for the startup. So the higher valuation they can get. Sometimes this is the case, but in many cases the situation is right the opposite. Why is that? Because the stronger the brand of a VC, the more deal flow, the bigger is the funnel of the deal flow. And they understand that entrepreneurs would like to close the deal, and they negotiate the lower terms, the more preferable terms for them. And there is another article talking about like why invest in successful previous entrepreneurs is could have benefits. So first of all, if an entrepreneur raised money previously raised money and was more or less successful, this person already has a network, and they can get a higher valuation because of like VCs believe that second-time entrepreneurs are more experienced, but essentially this person has a broader network of VCs, so they have they can make a competitive the deal more competitive, and it's actually mean that like more experienced entrepreneurs, they can raise money from like the added value which they get from VC with strong brand is less relevant for more experienced entrepreneurs, just because they already have the necessary network and network to build a business. It doesn't mean that they don't have the value of getting getting money from experienced from top VCs, but the value of it is lower for more experienced entrepreneurs. Then exactly like if you're in a step like well-known person, especially if you build a successful previous business, like the world knows about this, and yet your potential partners know about this, your future employees know about this, business angels know about this. So this gives you like easier access to the talent pool, to the partner pool, etc. And of course, entrepreneurship is like also is also the profession where you get skills as you go. So the more businesses you do, the more things you learn when you do those businesses. And the last question I would like to cover here is how to invest in other geographies. Of course, during pandemics, investing abroad for US VCs became more acceptable. But all in all, typically, venture capitalists prefer to invest in those countries they have they have a person in. So, for example, if a US VC would like to invest in Brazil, they at least hire one partner, which will be located in São Paulo. Why is that? Because first of all, when you have a foot on the ground, you know all the people, you understand what's happening there. Then you make sure that you get the best deals ever, because the best deal just because you see all the deals like available in this region. While in contrast, for example, your US VC and like some Brazilian entrepreneur reaches out to you, and you have never looked into this geography. So you're just dealing with a random person, and the chances that you're getting like the best entrepreneurs are pretty low. And and based on this research, so if you invest in other geography, the investors, first of all, they would prefer to invest in syndicates, at least with the funds, like well-established funds in those geographies, because like those well-established funds, they better understand like the environment and can pick the entrepreneurs more widely. Then typically they would prefer to invest with the smaller checks in other geographies. And in some cases, when it's possible, they would invest in tranches. So they de-risk try to de-risk those tremendous asymmetry of information they have when they invest in the other country. Okay, so this is it for today. These are my contacts. Please subscribe to me to LinkedIn and X. And looking forward to meeting you at our next lecture. Have a great day. Bye-bye.